Banks aren't places that earn money, they're places that create it. How is that possible? Because money is ultimately just numbers and credit. If banks run short on deposits, it doesn't matter. They simply type in the numbers. We borrow those numbers and pay interest on them. Creating interest out of thin air, that's modern alchemy. Today, let's talk about how banks really make money. To understand it, we have to go back to the early days of money. There was a time when gold coins were the main currency. But gold was heavy, difficult to transport, and easy to lose. So merchants began leaving their gold with a vault keeper and received a receipt in return. For large transactions, they simply handed over the receipt. The other party could redeem it for gold any time. These receipts became the first form of paper money. Then something interesting happened. People stopped redeeming their gold. They were trading the receipts instead. And the vault keeper had a thought. What if I make a few extra receipts? No one's withdrawing their gold anyway. So he did. He issued receipts backed by gold that didn't exist. And people accepted them because they trusted the system. That was the first moment money was created from nothing. But eventually, too many receipts were circulating, and people rushed to withdraw their gold. A classic bank run. The vault keeper had nowhere near enough gold and collapsed. Then the king got involved. Throughout history, rulers always needed more money. For wars, palaces, and luxury, but gold was scarce. So the king made a deal with the vault keeper. The vault keeper would issue receipts, and the king would provide the trust behind them. This royal guarantee created the first state-backed bank. With the king's credit behind it, people trusted the receipts even more. Deposits increased, and interest margins gave banks steady profit. Bank runs still happen sometimes, but the system worked well enough to continue. As monarchies faded and modern states emerged, governments officially adopted this structure and built regulations around it. This became the foundation of the modern banking system. Everything changed after World War I. When the United States abandoned the gold standard, the dollar was no longer exchangeable for gold. Its value came from trust in America, not metal. At that moment, money became purely numbers backed by belief. And the ability of banks to create money grew dramatically. Today, banks don't wait for deposits to make loans because, in modern finance, loans create deposits. When a customer borrows $10,000, the bank simply writes, loans plus $10,000, deposits plus $10,000. A new deposit, new money, is created instantly, not transferred, created. That's why deposits aren't a bottleneck anymore. And if the bank ends up short on reserves later, it just borrows from other banks or from the central bank. Loans first, reserves later. With the central bank behind them, banks can expand lending far beyond anything possible in the gold era. Money is just credit and numbers. Every time a loan is made, new numbers enter the economy. The supply of dollars rises and the value of each dollar falls. Warren Buffett put it simply. A $1965 today buys only 13 cents worth of goods, an 87% loss in purchasing power. So who benefits? Those who use the new money first. The government spends newly created money on public projects, pensions, and construction. It flows into contractors, investors, and real estate. Asset prices rise. By the time the money reaches ordinary citizens, inflation has already begun. The last people in line bear the cost. We saw this clearly in Germany during the World Wars. Gold was no longer needed, and the government printed money without limit to fund the war. The government spent first, and citizens suffered the consequences later, through hyperinflation and economic collapse. Banks today still stand right behind the government. They create new money through lending and enjoy the benefit before the currency loses value. That's why banks have grown consistently for decades, despite constant inflation. Of course, banks aren't invincible. Any bank can fail if a run happens. Some collapse because of bad investments or because interest rates suddenly shift and destroy their margins. That's why safety regulations like the Basel rules exist. But modern society runs on credit, and banks sit at the center of it. As credit expands, so does money. As money expands, asset prices rise. And the more expensive assets become, the more people rely on banks for loans. Naturally, bank profits grow alongside inflation and GDP growth. If you're thinking long-term, banks remain one of the most resilient business models in the world.